But you need to ask your parents that, see what they say.
That's a great question. I will definitely be asking my parents that.
Yes. Um, I'm gonna give it about another minute just to see who Jeremy is going to be letting in. And again, we're going to be having people kind of trickle in here.
Yeah.
I'm gonna do just a quick little update of all the fun stuff that we've got going on in real estate right now. And
Yeah. It's
then
the
we
Wild
will.
West, isn't it?
It is. Yes, we're taking a change, but um I am gonna probably interrupt you probably in the middle of what you're doing because I did have an agent reach out with an insurance question yesterday.
Yeah.
And
Yeah.
he can't be on the full call, but he had said like I'm gonna try and bop on, and then I said, well, I'll watch for you, and then we'll
Perfect.
get it. So
Yeah.
it was a very enlightening, and I'm like, oh no, Beth is going to be able to help us with this.
Hopefully, maybe it's funny because I mean, I've been in insurance for it's 24 years now, and both on the captive and independent side, and it is amazing to me the things I'm still learning.
Oh
Like
yeah,
you
every
think
day.
like, yeah, and it's like, I mean, and I started as a receptionist, and I've been on service, and I've been in sales, and so you think that like, you just realize it's humbling. You like never actually know everything.
That's right. And I like that attitude though, because it is always learning, always learning.
Yeah,
So
true.
all right, you guys, we're going to get this started. I know we've got some people trickling in, but I always say time is valuable, and I appreciate you guys showing up on this Tuesday. Obviously, it's getting recorded, and a lot of our other agents are going to be watching it back. But thank you for taking the time to join us on Tuesday. I try and bring as much valuable content as I can in front of all of our energy agents. Just a couple things. I know the past couple weeks we've been going over our new forms. We've been going over all the changes that are happening in our world starting in August. But a couple things that I want to just make sure that you guys are. I went to a forms class yesterday and I just wrote down a ton of notes. We're going to go over some of that stuff next week. But there's a couple points that I just want to make sure that you guys understand right out the gate. So first off, the new forms are going to be coming out onto our transaction desk on August 1st. So even though the settlement is saying we have to have these things incorporated on the 17th of August, they're coming out on transaction desk on August 1st. So make sure you're watching for that. If you have any, listings kind of coming in between or buyers, I would highly recommend at this point from that class that I went to yesterday, to wait for the new forms, or you're going to have to get new forms signed. So we'll go over that next week. I don't want to bombard. The other thing that was really, really heavily stated yesterday in this class that I went to, we cannot refer to things as commission anymore. We need to stop saying the word commission. We need to start saying the word compensation. Compensation. So I just really, really, I'm going to reiterate it. You're going to hear me saying it nonstop. Me and Randy had a conversation about it yesterday. And then the other thing is compensation, and everything is always negotiable. Negotiable. So make sure you're keeping those things in your mind. So again, we're going to go over all of that stuff next week. Do not panic. There's a lot to go over, but we're going to get you guys set up before all of this hits in August. So with that being said, I am going to give the floor over to Beth from Aspire Insurance. I actually found Beth from a broker that I know up north, that she was on Beth's podcast, and I watched it, and then I ended up watching every episode after that just because I got so hooked on it, and there was such good valuable information. So I was like, we got to get Beth on here. We have not had an insurance agent before come in, tell us about themselves, and also, the insurance industry is taking, a very big shift as well. So we are not the only ones in this that are shifting. So I want her to share that, and then also some tips and tricks that we can help our clients look for in the insurance industry. So Beth, I'm going to turn it over to you. Give us your background, tell us about you, and then we will get into the rest of it.
Sounds good. Thank you, Jill, for the invite. I was super excited to connect with you and to have an opportunity to speak with others and share a little bit about my story. And then really valuable information pertinent to both of our industries right now are going through a lot of different changes. Insurance, I know, directly impacts your day-to-day lives, really. I mean, especially if your clients can't procure insurance, that kind of stalls the market in a whole different kind of way. So I'll share some tips and tricks and what we're seeing as well. So I kind of wrote a little agenda, so I'll just share that with you so you can kind of know how I'm tracking. I was just going to share a little bit about my story and insurance, so you know my background and that when I'm speaking that I actually know what I'm talking about. I'll share just a tiny bit about Aspire, which is the independent brokerage that I own. And then we'll dig into like a big picture view of the state of insurance and then drill it down to tips and tricks and how you can best help your clients navigate this crazy market. So a little bit about me. So my name is Beth and I own Aspire Insurance Group. We are a independent, I call us a boutique brokerage. We really focus on high touch, high quality. We have over 150 different companies. So I really focus on our diversity in the marketplace. So we basically just don't have to say no to anybody. There's always a way to help. I started in the industry completely by accident when I was 20 years old. I needed to pay my rent, and I had had a series of very strange circumstances, working in a daycare center, working for an attorney, and then I ended up stumbling into this insurance agency where I started as a full-time receptionist. And everything kind of clicked for me there. I ended up getting licensed 3 months later, and I was working at this point for the Big Red Farm. So you guys, you know, the friendly neighbor. I was staff at an agency there. And I was there for 10 years. And I would say it's really funny because I learned really good operations, how to really run a well-run agency. I was in my tenure there, started as a receptionist, went into service for both personal lines and commercial lines. I went into management, just office management, and just kind of was on all different roles within that agency. And the struggle that I had there is, since we're all have some sales component to what we do, is I am a farmer. So I love relationships, taking good care of my people, and that's how I grow. And there it was cold calling central, which there is nothing wrong with that, but it is not my natural how. And so there became a bit of a friction because the how of this agency didn't really match my how. And so I remember at some of my in reviews for my work, I would even do different tests and be like, here are my strengths. And they would kind of laugh at me. And actually for 10 years, I will tell you that I was just completely told all the time that you are just an order taker. And so by the time, so I will be writing a book and the title is Order Taker. That's going to be in the next couple of years. So anyway, so by the time I was 30, I decided that I was going to roll the dice on myself. And I left with no clients, completely cold turkey. I honored my non-solicit, which was not legally binding. And I started a book of business through the independent sector. And this is where I learned that I thought I knew insurance for 10 years and I actually knew nothing, because the independent side is wide and deep, and it is like the ocean. And I had been like, swimming down like a little tiny river. Like if any of you know, like the River Falls area, they have the Kinnickinnick River, like I was in a kayak going down the Kinnickinnick and I was thrown into like the ocean. So I had negotiated my first right of refusal when I went on board with this independent agency, starting a book from scratch. And I built there and really took a deep dive into commercial insurance and just the difference between being in the captive world and then now being in the independent world. And 3.5 years later, I should say, I did that. So my kids were 2 and 3 when I did that. So that's an important part of the piece because Aspire's built different than traditional agencies. When I decided to leave, my kids were really young. And so I had to build in a way where I had a lot of freedom and a lot of flexibility of my time, which meant that I actually built us in, hold on. I built for 3.5 years. I had a vision of what I wanted. And basically it was that I feel like insurance is a really great career. I actually just adore my industry. It is a helping profession, and that is how we approach it. So after 3.5 years of building my book, I bought my book and I started Aspire in 2014. But I had to build us different because my children were so young. I had to have an abundance of flexibility. And so I built us remote starting in 2014. So we have always been a remote hybrid type of agency. And we do some unique things like unlimited vacation. My team has unlimited vacation. It works beautiful for us. We have some, you have to have boundaries around privileges like that, but it works beautiful for the agency. So we are really built with a freedom mentality, with client advocacy and not being crabby, because I swear to you, I felt like the thread across so many insurance agencies is you call a service person and they're just crabby. The salespeople are happy, the service people are crabby, and there's a big rift between the two. And so I was wanting to design something that was just happy, like people have smiles on their faces. And so this year, so flash forward 10 years, we've organically grown a lot. I did my first acquisition in 2020. So we have 2 locations, one location's up north on the Iron Range. That was my first acquisition. We did a second acquisition, which was in actually April of this year was our second acquisition, which was down in Janesville, Wisconsin. And other than that, it's been organic growth. So this July, actually July 1st, we turned 10. We crossed over 7 figures in revenue, and we are a team of 10. So right now we are larger than 82% of agencies nationwide, and still growing. So that's a little bit about our path, and I'm super proud we have just an amazing team. A little bit about Aspire. So we are remote hybrid. So like at any given time, we have people at home, people work. So we are in like Teams, and we use Slack as well. We use both Teams and Slack. It depends on what it's for a lot. We have, I would say, one of the things when you hear insurance agents, they'll say, oh, what sets us apart is that we give great customized service. Well, those are just words, but we measure. So we have an internal net promoter score. So it's our clients telling us how we're doing at serving them. And right now that's at 93%, and an average agency is 74%. And that's also during a hard market where everybody hates us because the rates are doubling right now. And even though we don't have control over that ourselves, we are definitely, there's a lot of shooting the messenger going on right now. We have been featured in this past August. We were featured in a magazine called Rough Notes. It's a national publication that goes out to 40,000 agencies. And so that was a huge honor for us, because it's a board that decides, and nobody knows who's on the board. And so I was absolutely shocked, because here's what's really funny is that was one of my written goals for that year, is I wanted us to be on the cover of Rough Notes, which I don't even know how you make that up, but that worked out that way this past year. So that was a huge honor. I would just say we have a real growth mentality. not going to be your big commodity shop as far as like, we have a ton of companies, but we will focus on your quality of coverage first and then price second. Mainly because your insurance policy really needs to be there and respond to you and your clients when they have a need. And I'll give you an example, and this is a real-time example. At our location up north, so we are located, our physical location up there is in Gilbert, Minnesota, which is about 10 minutes away from Virginia. It's part of the Quad Cities up on the Iron Range. And they had torrential rains, like crazy amounts of rains over a real short amount of time. And unfortunately, the city of Virginia at that time happened to be doing some construction work on part of their sewer system. And so, of course, it's the perfect storm. The infrastructure in Virginia was overwhelmed, and we ended up with a ton of backup of sewer and drain from the municipality. So we had sewage in basements, and I mean, it was a lot of sewage in a lot of basements. Now, a regular homeowner's policy does not include backup of sewer and drain. That is an extra coverage that you have to endorse on a policy. And that is part of our minimum standards to add onto a home policy. Now, granted, it's probably going to add $100 or so a year, give or take. But we see so many of those claims. And so guess what? We have had zero problems. They've all been covered. But we know an agent that's just down the road and he had not been adding them on, and there's, just a lot of crap going on, pun intended. So anyway, yeah, Aspire is the team is, we are happy, we are kind, our core values are growth, raving fans, team. And that's, it's just who we are at our core. We truly live by our core values. And so a little bit about the state of insurance. So this last fall, when we kicked off our fall planning meeting, I should have brought a sweatshirt in because I have an extra one out in the hall here. But I had a sweatshirts made for the team. And I don't know if you've ever seen those, the Barbie that looks like super disheveled, and she's just a big hot mess, and she has like makeup all over her face and like ponytail on the side. And so I actually had a sweatshirt made with the picture of that Barbie on the front, and it said Hard Market Barbie. And then on the back, it said Aspire Insurance Group, because that is what the market is right now. In my 24 years in this industry, I have never seen the things I am seeing right now. So what we're experiencing is, first of all, giant rate increases. In 2022, Minnesota was #1 in the nation for rate increases in insurance. So your clients are going to feel it. This last year it was Texas. So we are seeing our biggest rate increase so far has been 138%. These are not fun phone calls to have. And it is happening for a variety of different reasons. Number one, our weather patterns are absolutely bonkers. So insurance is based on statistical information. Our historical statistical information does not match what's been happening over the last 4 years. It's actually been since 2020 that these weather patterns have changed tremendously. So before 2020, on average, the 40-year period before, they would see about 7 incidences per year where over $1 billion was paid out in insurance claims. Starting in 2020, all hell broke loose. And I will tell you, I don't remember what year coincides with what, but it's been 23 incidences that are over $1 billion, 18 and 22. Like that's been, so like basically all hell broke loose in these companies. The policies have not been priced for the weather that we're experiencing. You take that and then you add inflation. So fixing cars is so much more expensive than it used to be. Even just take a simple windshield. Like now we have to like, it's not just replacing the windshield, but it's the recalibration and all of the technology that's built into the windshields now that wasn't before. You take building costs have gone up tremendously. If anybody is into new builds, like you're just going to see that. I mean, we all know about inflation. We've all feel it. We all go grocery shopping. So insurance is reactionary with that. So it is paying for all of these things that have increased, and it's also having an increased experience and losses a lot because of weather. And on the property side, and I'll just touch real quick on the auto side. On the auto side, the telematics data. So if you ever have like Progressive Snapshot or all companies have some type of telematics for auto. Our driving after COVID is like way more angry and aggressive. So people are not like the data shows like people are just kind of mad. So that obviously the more aggressive driving is going to translate into more accidents and stuff. And data does show in Minnesota there has been an increase in fatalities, not so much in Wisconsin. So it's kind of mixed there, but in Minnesota there has been a bigger increase actually in fatalities and just incidences overall. So there is also, we have, so what are companies doing? What's one of the biggest problems that we're running into is the departments of insurance. So the state-run departments of insurance, when companies are coming and they're filing for their increases, because they have to file with the state, get approval from the state, and then release new rates. They are in a way being held hostage because these Department of Insurances are not responding quickly at all. And so what it's forcing the insurance companies to do, which is then impacting all of us, is we have been running into what I call insurance company whiplash. And basically what ends up happening is companies, first of all, will get as much as a rate increase as they can. Second of all, because they're literally all losing substantial amounts of money. No one's running at a profit right now. I would say maybe this year we're going to start seeing some profit depending on weather. But they will all of a sudden we'll get a memo and it will say, as of noon tomorrow, we're not writing any insurance through the rest of the year. They will completely cut off, completely. Or you will also run into some that will say, we aren't quoting anything without a bundle. So if you're not bringing the home and auto here, we are not quoting at all. Part of that, and this is a good piece of information, is the loss leader. So the biggest claims prediction is monoline. So if we just have a home or we just have an auto, that one piece of business has a higher risk of having a claim versus if you have a bundle, actually the claims, they go down. It's for whatever reason that is, and companies clearly know that. So that's one way for them to slow down the business and to control their loss ratio is to make sure that we're bundling. The other part that we're running into is companies are mandating that you have certain deductibles, especially on wind and hail. And be very careful when you're paying, if you have a client who has a quote, watch this, because this is an area where I am finding there is a lack of awareness and education around this, like significantly. So it'll say 1 or 2% wind and hail. Okay. First of all, clients don't know what a percentage is. I mean, is it the percentage of the loss? Is it the percentage of the dwelling? So it is always the percentage of the dwelling coverage. So if you have a 1% deductible on a $700,000 house, it's a $7,000 deductible, right? And it goes up from there. And it's not being explained well to people. So that is, I prefer flat deductibles that are the same for wind and hail as they are for theft and fire. Because it keeps it simple, it keeps it consistent. So like we have been quoting a $2,500 deductible across the board. And I think that would be my suggestion right now. Companies will, the more risk that the client was willing to take on, then the lower the premium. So it's a way to lower that premium. And a lot of companies, will get much more comfortable with quoting and writing a policy if they see that the client is willing to take on a higher deductible. So we're having a lot more risk transfer conversations and kind of realigning, like, okay, insurance is actually supposed to be here. It's not a maintenance policy. We have warranty, policies if you want one, but it's really supposed to be there for situations that you can't recover from on your own. So kind of changing the mentality. And when you start having risk transfer conversations and you start getting into a little bit higher deductibles, so that helps control those premiums a bit. We have also run into insurance companies just completely dropping personal lines and leaving the market. Secura most recently did that. West Bend most recently put a mandatory 2% wind and hail deductible on other home policies. So that's something to really watch and be careful of. We have a Penn National, which is a super regional. So we really like them. They kind of stick in the Midwest, so they don't have the exposure of the coasts. But what happens with them is they haven't got approval on their rate increases, which plays out well because they shine, their rates are really good. But what they'll do is completely turn off. And then when they're ready for a little bit more, they'll just open it back up and then they'll completely turn off. And then, so it's something that we've never experienced before. We're also running into companies limiting how old the roof is. So this is, or what zip codes they're willing to write in at all. So you'll run into some companies saying, we're not going to write in the metro for the rest of the year, but we'll write in the suburbs and rural, because they don't want a saturation of business in one area, because if it gets hit, then they are in a bad situation. So especially around the metro, you'll want to make sure that you're encouraging clients to really get quotes ahead of time, because those are going to be areas of saturation, and you're going to have, depending on if that company has a saturation in that area, you could have some access issues there. And let me try to think. So you'll have companies that will limit metro, they limit roofs. I'm kind of the first, you kind of have the first like 1 to 10 years, you'll kind of have the most availability with companies. And then the next is like 10 to 15. There's some companies that will still go there. But then once you get over 15 years on a roof, you're going to have some access issues, and you're going to have, most commonly, you're going to see actual cash value on those roofs, not on the whole house, but you'll see it on the roof. So just be kind of ready for that. When you see those little bit older roofs, like companies are just very scared of them right now.
Beth, this is a great point that I want to bring up, because you actually brought up a couple different things. Peter, who I know is on the call, he does property management, and I'm going to have him unmute himself and share something that he shared with me yesterday, and kind of see what your take is on that.
Yeah, go for it.
Yeah, so I have a owner of a home who is transferring title from his dad to him, and he needed to get a new insurance policy on the house, but the insurance company requested he go take a bunch of photos of his house, and they actually they determined that there was damage, and they won't insure him until he has it repaired. Is that kind of a new trend in the industry right now?
Yeah. That does not surprise me at all. I think you'll have to look at then. So is it, you said father to son? It's transferred?
Father to son. Yeah. And then he needs to get his own policy to cover the house now.
One thing that you can do there is have you looked at the father's policy, and is he able to,
we're in the process of that. We're going to determine if his insurance previously will cover any of the damages, but based on what my roofer told me, doesn't look good.
Okay. So if that, this can play out in a variety of ways. If the policy ends up covering it, you know, you can go through like the claim process, right? And a lot of times if you're writing a new policy, you can say, hey, this work is being done on this, like, so you could put, let's just pretend it's a roof, because I swear that's always what it is, right? So the roof is being done, let's just say that we're on schedule for August of 2024. Well, that insurance company has, you know, their window of look-see time frame where they can still cancel the policy. And so if you have a good relationship with your underwriter, you can call and say, hey, here's the situation, give them, like, explain the big picture, and then just say, can we, you know, write this policy, say the roof is updated at, you know, this time. But then they'll have this window of time where if the work isn't done, they can still get off of the policy. I have done that a handful of times. It's not uncommon. You can't do it with some of these with some of these companies now, where some of the underwriting, well, a lot of the underwriting is automated. Like, those aren't the companies, but the companies like an Auto Owners and Acuity, a Penn National, so those super regionals, those are going to be ones, even probably a Safeco, which is a national, but I can see them kind of being willing to be okay, get comfortable with something like that.
Mhm.
So, but we can run it through. There's a number of different scenarios. I mean, I don't, it depends on, like, the loan too can specify what type of insurance needs to be on it, like a replacement cost policy. So if there is a loan, if there isn't a loan, it might even just end up being something where it's actual cash value until there's repairs made too, which unfortunately has become more normal than it ever has been.
Yeah, and I'm third party in this, so I'm trying to problem solve it, but maybe it's worth having that owner get in touch with you.
Yeah, I'm happy to be a resource and walk through, like, because it things, you know, one small detail can change the trajectory of the entire, how everything plays out.
I did hear that the insurance companies are getting so aggressive with this tactic that they're flying drones in certain areas just
Yeah.
to preemptively check out roofs. So
They
crazy.
are, they're using Google Earth. They're doing a lot with drones. There's also yeah, I mean, they're really using a lot of technology right now. So, like, they're, you know, yeah, it's very interesting times.
So get your roof fixed, right? When you have the opportunity.
Yeah, it's really they're not messing around.
Thank you.
Yeah, my pleasure. My pleasure. So let me trying to think here. We also have a very unique situation. This is my personal opinion, and something that I've always stayed away from these small mutual companies, because they just they're not big enough to absorb large incidences. And but they've always been very aggressive on price, which, you know, I've still just, I have to, like, kind of honor my gut on some of these things. And so this is an area where I've always stayed with super regionals and nationals, and I've stayed away from these small mutuals. And so I'm on the board of the Wisconsin State Insurance Association, just because we're domiciled in Wisconsin simply because I live in Hudson, even though the majority of our book of business is actually located in Minnesota. But we have had a situation in Wisconsin, and I think the story, there's a lot to be gleaned from it, is so the beginning of last year, the state of Wisconsin had about 50 to 53 different small mutual insurance companies. So it'll be like the small farm mutuals. Sometimes they'll write in like a 7-8 county area, or they just are only in Wisconsin, but they're just a smaller insurance company. And we had one company called First Auto and Casualty, I believe is their name. I know I have the first name, First Auto and something, but I'm pretty sure it's Casualty. Anyway, their loss ratio, their claims experience was so extremely high that it not only took out the insurance company, it took out the reinsurance. So insurance companies have insurance to back them up. So they took out the reinsurance company, which happened to be the reinsurance company for all of the mutuals, for all these small mutuals in Wisconsin. And so all of a sudden, these small mutuals don't have a backup, and they're very small. And so as a board, we have navigated watching these small mutuals go insolvent. And we currently, as we stand right now, so this is, a year and a half after the crap storm happened, we are down to 7 that are still standing. And so when I talked about Aspire being more of a boutique agency, like, we're always going to focus on quality. We are inherently competitive because of the companies that we have. So price does matter. It's not that I'm saying it doesn't. I'm just saying that actually your coverage matters first. But the quality of the company that your clients are placing their insurance with is more important now than it has ever been. A lot of these companies, when you see them starting to have financial problems, how there's a saying, like, people show you who they are. Insurance companies also show you who they are. And their ugly side comes out when their balance sheets don't look so hot, meaning, claims slip. And so we have, watched, our other agencies that I know that have done business with these small mutuals. It is a really sad state of affairs right now. They're moving everybody, but it's in a hard market. So you have the access issues, and then you have something going from a really underpriced book of business that wasn't appropriately priced to now in a marketplace where there's not only the access issues, but now the rates are what they are. And it's just been really hard conversations. And there's one company that I know of, and the name is RAM, and they're not in Minnesota, Wisconsin. But when they went insolvent, they didn't return premiums and they didn't pay claims. So it's not a good look when financial problems are there. So the stability and the quality of the company is really something that's important to look at. So I really encourage those super regionals and nationals. Super regional for me is like the sweet spot because you don't have the coast exposures typically. So that's a little bit about the state of insurance. So if you know an insurance agent, give them a hug because they have definitely earned their stars and stripes the last couple of years. I would also say from Aspire, like, we are looking at the market as an opportunity because it's really like cutting the fat. There's a lot of people that were here during a soft market that were just see dollar signs, and it's really getting rid of the people that were, not meant for this industry. So we've been able to grow through it. Our retention has stayed high, and we are definitely battle ready at this point. So let's chat about some ways you can help with your clients. First of all, the one thing that I would say is when you're working with a loan officer, they have the calculators for, like, how much is it going to cost my client for insurance. I would just be on the front end of this and do them a favor and say, whatever the mortgage person says is going to be the estimated cost of insurance, just double it. And then that's probably what it's going to be. Because those estimators, first of all, they've always not been great, because we'll get phone calls and we'll be like, I need the insurance to be this much. And I'm like, well, we got, not only do we have insurance score, that's a whole different animal, but then we also have, the state of where the industry is right now. And so that's one big thing that I'm seeing is, but my mortgage person said it was going to be this much. Well, they're not an insurance person. I don't know what kind of software system that they have, but that's not, accurate. So educating on the front end about that. Number 2, I would say work ahead on getting quotes. Some of the things that you're going to find, just tips and tricks, is if you're in any kind of metro, there's going to probably be a little bit more access issues just because of saturation. Another part is if the roof is older, I just take it 10 years or older, just know that there's going to be, it decreases the amount of companies that you can shop with. And so older roof, and then oh my goodness, I had a third one, and that was like my favorite point. It'll pop up. So the other part is, it is quoting higher deductibles. So I really we like to start at a $2,500 deductible now. You know, even just 4 years ago, 1,000 was more normal, whereas now 2,500 or above is normal. Let's see here. Bundling, another one would be, you know, looking at doing home and auto, like really getting a full account is going to broaden the companies that you can look at. They're really finicky on that piece right now. What we're finding more often now, that as when we're doing reviews with our clients, is we're really finding that we're not moving a lot of people with insurance. We're actually finding with current clients that we're actually reworking their policies most often rather than moving them. So, but the industry shows us that more people than ever are actually going to be shopping their insurance. 25% of the actual industry will be shopping, which I think is wild because that is not normal at all, but it just is a reflection of the disruption. A couple things that I would say is, if you are helping clients with policies, that backup of sewer and drain is something that's not included on a normal home policy. I know I've said that, but that is an endorsement that really should be added onto everything. I cannot tell you how many of those claims come in, especially around springtime. And you know, that is a really it's a very gross claim to go through, and without having it paid for you, it's not something that anybody wants to navigate. The other part is flood insurance is not covered on a regular home policy. And fun fact is that the majority of flood claims are not in flood zones. So, you know, we have the flood zone maps, but it's, you know, but that's not actually the majority of where flooding comes from. So, just be aware of that, because it is, you know, with all the rain we've been having, I feel like we need to make sure we have water conversations. Let's see here. Last, I was going to talk on condos and townhomes. Okay, so I'm thankful for my State Farm years, because this is where I learned all my condo and townhome stuff. So when you're dealing with condos in the insurance world are written, it's called an HO6. So an HO6 policy is going to have a couple different parts. They're going to have a dwelling coverage part, and they're going to have a loss assessment part. The dwelling coverage is there to fill in any gaps that the townhome association leaves the unit owner. So I'll give you an example. They don't include fixtures like light fixtures, toilet fixtures, anything that needs to be plugged in, like a refrigerator, like that's not part of it. So then that's something that you can put on, you know, the dwelling coverage to fill in the gap that the association left the unit owner. The other part is loss assessments. So in a townhome or condo, the association traditionally, not all the time, they insure the structure of the building. So it's almost like they have the homeowner's policy. But then a lot of them, especially right now, this is what we're finding, are having these giant deductibles. Like we have a handful of them now that have a 50 to 200,000 or more deductible. So loss assessments is there. So I'll give you an example. I feel like stories are the easiest way to understand. If a big hailstorm goes through and your roof has, you know, hail damage on it, everybody's roof has hail damage on it, the association will take their deductible and they'll break it down, divided by however many unit owners there is, and they will assess that portion of the association deductible to the unit owner. So then what the unit owner needs to do is they need to come to their insurance agent and say, here's my letter, this is how much I'm being assessed because we had a hailstorm. And then we turn it into the company, and then the unit owner gets a check for their loss assessment. So that portion, their portion of the deductible is just taken care of. Okay. So what we're running into is that these associations are having these large increases in deductibles. It's not being one of two things. It's not being well communicated to the unit owner, or the unit owner has no idea what that is. And so they don't know to like just call their insurance agent and give this information to them. And honestly, sometimes you run into insurance agents that have no idea how to deal with an HO6 too. So I would say that is one area of that loss assessments part you're going to really need to pay attention. I would say it gets a little complicated. Feel free to use me as a resource on that. But you're wanting to, that's a piece on the HO6 policy that you're going to really want to start watching. And you want to stay away for sure from Progressive on an HO6 policy because they cap the loss assessments at $2,000, which is nothing. So if you see that, like if someone calls Progressive Direct and they get an HO6 quote, to run, like they're in 0% of the time are they appropriate for an HO6 policy in this day and age right now. They did that last year and everybody rewrote everything. And they did it intentionally to get out of the market because they know that this is the loss assessments portion is going to be an ongoing hurdle. So I would say start early with your quotes. And I would always encourage an independent brokerage so you can shop around versus, being a captive, you have one option and insurance is cyclical. And so you don't, the right option's not always, one certain particular company. So that's kind of what I had. Jill, is there any questions?
I just want to follow up because I was taking some notes and there's things that I want to say about you, Beth, that are very, very similar to what people in our industry need to be doing. One thing that I will tell you is you doubled down on yourself. You believed in yourself. And you believed in your company and you went all in. And I love that. I love that. So good job. The other thing is that sometimes where we are in real estate, we feel like we are the only industry going through these crazy times. You guys have been going through this for the past couple of years now. I hate that you're going through it, but it's also very refreshing for us to hear that there are changes happening in lots of other industries as well.
And commission cuts. I forgot to say that, but we all understand that, but we've been having commission cuts as well.
Yeah. So it's very refreshing to hear that. The other thing that I'm picking up on is customer service and educating people, because everybody knows I've been preaching about that. But those are really big key factors. And so it's just literally believing in yourself and then putting your client first. And that is what I'm hearing from you just consistently. So I love that.
And it's the funny thing about that is when you do that, like when you put the client first and your decisions are client centric, they're not driven by the financial piece. The financial piece has this really funny way of absolutely falling into place. Like it just is almost like, I'm not a big like law of attraction person or anything like that, but it actually is just like, it always works that way.
Yeah. And you manifested something, by saying, I'm going to be in this magazine. You manifested it and it came, it happened. So you did it.
So weird.
I love that. There are a couple questions in the chat that I'm going to have you take a look at and address. And then open up the floor to see if anybody, wants to unmute themselves, ask some questions to Beth, as long as we have her here.
I just want to say, I think this is one of the best huddles for a long time. And I'm always talking to my clients, kind of giving them inside real estate, and I've never been inside insurance. And it is really helpful to know what you have shared. So thank you very much. Very much.
And my pleasure. I think isn't there a lot of power in just kind of pulling the veil and like just showing like the ugly of what it is. And especially since you guys are navigating, your compensation and we're having ours, played with as well. So there's a lot more in common than you realize when you open up those lines of communication.
Yeah. And I did put it in the chat, but I just lost a deal. I sold a condo in St. Paul, and the associations are raising their deductibles past what Fannie and Freddie will tolerate.
Yeah.
And so then they're not on the approved finance list. And many closings occurred in this building in this year. And so I'm not sure when they changed the deductible or who actually got financing, but be careful if you're out there working with condo buyers because of that differential. And so then we started, okay, well, we'll try with something else. And there were 2 other condo associations that their deductible was too high, and Fannie and Freddie wouldn't approve it, so they can't get financing. So that's that. Too bad, so sad.
Yeah. This is one area as I'm watching insurance kind of in with the townhome and condo, like they're so scared because what they're looking at is the area of the roof and how much that's going to cost. Like I know one of the associations we have last year, they had a hail claim, and it was over 600,000 that was paid out just for the roof. And so that, I mean, that company is like, oh my gosh, that's a big chunk of change for just a roof, And so, yes, I think there's a big disconnect right there between Fannie and Freddie and then what the insurance companies are doing. And I think we're, between both of our industries, right, we're going to start getting stuck in those crosshairs. So this is one area I would say, and I am happy to be a resource here because there are some really weird nuances on that HO6 policy between dwelling and between loss assessments that you really, really need to know what you are doing. But you need to be, if you have a client and they get an HO6 quote, the one thing you need to do is ask them, did your insurance agent ask for the bylaws and a copy of the insurance policy? You should not be quoting an HO6 policy without looking at those documents because you don't know how to actually structure the HO6 policy without looking at those documents, especially right now. There's a lot of agents that are stuck in that commodity cycle, so let's throw a quote out to you. But I am aware of stories that of people that have been just given quotes and they haven't been asked the proper questions and they have been out substantial amounts of money because it wasn't structured properly. So just be very you might even just be careful on that. I would say the litmus test is did they ask for the bylaws and did they get a copy of the current policy? Those would be the 2 things. If they did, they wouldn't be getting them if they're not going to take the next step. So to compare the documents. Yeah. So and the other, there's that. And then actually weirdly, the Wisconsin State Association that I'm on, actually Freddie and Fannie, they were trying to pass something that said like, you can't close unless you have a I don't know if it was replacement cost or guaranteed replacement cost policy. And they were actually like right on the verge of passing that, but the Wisconsin State Board got a hold of it, and we actually our CEO wrote a letter and actually got it repealed because that would have been, I mean, it was so under the radar. That would have been a huge issue because with some of these roofs over 15 years having to go actual cash value, that would have actually stopped funding there too. So there's a lot of like little tiny areas that are kind of sneaking up that we need to be watching for.
I think you should talk to homeowners associations and explain to them, condo buildings, look, you guys, your owners are, for all intents and purposes, underinsured. And the lender had said they had another client where they actually convince the homeowners association to reduce the deductible, and it was only like $20 or $30 a month for each owner.
Mm-hmm.
And now, you know, this building that I wrote on, it's a cash only building. Well, who has cash now?
Yeah.
You
Yeah, I
know?
mean, it puts that building in a really bad position as far as, and those unit owners to move those units, like that's I really do, I think what you ran into is something that you're going to be probably finding more and more. So, and I think the biggest issue is going to be the affordability of the insurance policy and the reason, and then, a lot of times the reason they're having to go to these higher deductibles is because of the affordability of the policies, or if it does have a little bit of an older roof, some companies won't write it unless it has the larger deductibles. So there could be a couple different things that are going on there.
Good
yeah.
conversations. I like that. There
Yeah.
is a few more things,
Yeah.
Beth, in the chat before we end. I did put your contact information in there, so that is
Thank you.
definitely in there to reach out.
Yeah.
But if you want to read through Peter's question, Pam's, and Darkus has a question in there.
Yes. I'll read them out loud. So Peter, what might be the impact of buyers when they're shopping for new home and could they close without being able to get insurance until they make a $15,000 to $30,000 repair if they didn't get a great inspection or waived it? So I think as far as you would have to go back to probably the loan documents as far as what the loan says the insurance needs to be. If they can even get like an actual cash value policy too, you know, I mean, that depending on if it would be acceptable to the lending company, because a lot of times they will have specifics like the maximum deductible or it needs to have replacement costs on it. So we'd have to look back there to see, but it might just be an actual cash value policy and then just rewriting it. And there is a possibility too, and you'd have to check again with lending guidelines here on this, but if you are for sure that they're going to be making the repairs, there is a possibility of using a builder's risk policy. You'd have to like explore that a little bit, but a builder's risk would basically be like, hey, we're buying this house and we're fixing it at the same time. And then once it's fixed, it can convert into a regular like home policy. So
yes, just to clarify, I mean, I'm a bit novice in the whole closing process, but you know, I know when I bought my house, I didn't even think about insurance as being any sort of issue, but with things tightening up the way they are, like there could be some just unpleasant surprises in terms of that little process, right?
Right. Well, and to your point, Peter, like the last time the majority of people bought, it was when insurance wasn't a big deal. So that's a completely blindsided. So that's why it's really good to do some education on the front end and just say, hey, I know insurance is really a tough market right now. Work ahead and don't, you know, and double whatever your mortgage person estimates for insurance, just to set the stage, because if you can work ahead, you know, honestly, like everything's figure outable. And that's part of like what I love about this industry and being independent too, is just the fact that like you can take a situation to be like, okay, there can usually be like a variety of ways to get one thing done. You just have to be able to kind of think outside of the box. But I think, you know, even just what I was saying, like an actual cash value or even possibly a builder's risk could be a solution in this situation. I think a lot of it's just going to be more like, what would the lender feel comfortable with? Because I think the actual cash value piece could be, that might be concerning to them. But then also the builder's risk, I know in some situations when I brought that up, they had a different way that they had to lend when I've had to go that route. So there could be a couple different ways there. That's assuming there's a loan that's going to be involved in this. I don't know if there is or not.
Yeah, thank you.
Yep. Okay. We talked about associations. Let's see. Yeah. On percentage of book of business, Personal and commercial, we're actually split right down the middle. I do a lot of commercial insurance. We actually write, we cover some different municipalities. And we are a generalist when it comes to commercial insurance. So you can take me from a golf course to a salvage yard and we're good to go. You have contact information. Let's see here. Okay, Janelle, I have 2 buyers. One is having difficulty in getting insurance on buying a home still under construction. And the other needs to know exactly how much over the 8+ years the roof is. That would be true. The disclosure says, just says over 8. And I foresee insurance issues with buyers, unlike private. Yeah, for sure. Okay, so first one is if the home is still under construction. So usually when a home starts construction, that's when a builder's risk is written on it. If it's in the middle of the project and there isn't a builder's risk, you'll run into problems with getting insurance on it mid-project. That's actually just like one of the biggest snags that you can run into, but typically either whoever's building it would have a policy on it. And also it depends on like where in the project it is, because it could be that if it's just some cosmetic things that need to be done, that we could write just a regular homeowner's policy on it as long as the majority is done. So that is like, there's a lot of gray there, Janelle. So I would, if you would like to reach out to me, I can kind of walk you through like some different ways that can work out. My brother is actually does custom homes. And so this is the builder's risk arena is something I'm really familiar with. And then, so as far as getting to know exactly how old the roof is, typically there's going to be a permit pulled. And so if the agent that is quoting that, there is a resource through Travelers where you can actually look up the address and then it will pull forward the permits that house has had on it. And it actually like will say like roof or other, like there's like it looks like little tiles on the bottom, but one of them specifically is roof. And so if they have access to that system and they just use that resource within Travelers, they should be able to look and see exactly when that permit was pulled for the roof. That's what I would do. But it should be on the permit would be the best way to look. That's something we do all the time. Because a lot of people just don't remember that kind of stuff, which I understand. Let's see here. The policy that would cover the home being rehabbed and will be insured when it's habitable is called a builder's risk policy. Couple things about builder's risk is they do need to be written before the project starts. And there are a bunch of different companies that handle builder's risk in different ways. So it is one of the risks on builder's risks is, so let's just say builder's risks are mostly written on like a term. So 3 months, 6 months, 9 months, 12 months. Most of the time, if say the project, you write it for 9 months, but it's done in 6 months, you don't get that remaining premium back. Traditionally, there are some exceptions. But on the opposite side, if you write it for 6 months and then it takes 9 months or a year, typically you can extend it, but there are times where you can't. And if you can't, then there's no one that will fit in that space and write a policy mid project. And so having somebody that knows their way around builder's risk and how to write them, I like to write mine if I can through a company called Auto Owners, because with Auto Owners, you can write the builder's risk. There's no like, they have you estimate the time frame, but it's not written on the time blocks. And then there's actually just like a button that we hit when it's done. And then provided that's a homeowner's policy, it just converts into a regular home policy. So it just makes the process like it's less risky to the clients. And so I like to write our builder's risk through them. We do have a lot of markets for this because we write builder's risk for a lot of the local builders. Let's see here. And Janelle, yes, reach out to me on the mid-construction. We can kind of spitball that because we'll see what can be figured out for that. Yep, and you can call the city for permits pulled too. You are correct. So I think that's.
It does. No, that sums it all up. Beth, I want to know where can people find you besides the contact information that I had? Tell us about your podcast and like where the best social platform is to find you.
Yeah. So yeah, I have a podcast. It's called Unraveling Success. And basically it's just, you know, at some point you get to the this point where people recognize you and they don't know all like the carnage that happened to get where you are. And so it's really just talking about the stories behind people that have reached some level of success. I really focus on entrepreneurs that have hit 7 figures and those who have worked their way into the C-suite. And so basically they just share their story about like the things that were hard and the lessons that were learned and how they got where they are now. So there's that. Otherwise social, I mean, honestly, like mostly Facebook and Instagram. Clearly I would be on LinkedIn as well. So I'm on there a bit. Yeah, I think.
No, that's perfect. I want to remind everybody because we are, you know, we have Wisconsin agents, we have Minnesota agents, we have Tennessee agents on at Energy. So definitely Beth is a resource because she is in Wisconsin and Minnesota. So that's why we pulled this in. Even, you know, Janelle, I'm thinking about her because she's up north. So I'm like, oh my gosh, there's so many good resources here. So you guys definitely reach out to Beth with any of those questions you have in reference to insurance. We will have her on again because I know there has been such great feedback and just such great information. And again, this is a tool we're putting in the toolbox and we will reuse this resource, but it's what she had said also, problem solving. That is the name of the game on what we have to do. And it's making it better. But guess what? She's in that also, and she wants to help you problem solve it. So please, please reach out to her with any questions. Beth, I want to thank you for your time. Such good resource. Thank you. Thank you.
Throw my cell phone in the chat. And I would say also just a quick note, just because I have like Fort Knox protecting my phone calls. Because I get vendors trying to suck the blood out of me. And so, but this is, if I don't answer my call, text me and then I will answer my call. So I just get so much coming in that I kind of have a little bit of a guard. So, but there's my cell and, you know, feel free to use me as a resource. I am happy to help and make sense of this craziness.
Absolutely.
Another great meeting, Jill. Thank you.
Thank you. Yes. I just want to remind you guys
for sharing your time and knowledge. That was an awesome meeting. Appreciate it.
It was. Thank you. Remember, and again, we're going to be talking about this in the next couple of weeks. We are not using the word commission. We're using the word compensation, and it is always negotiable. So with that, you guys go out, do something amazing, spread some joy into the world, and have a great week. Thank you, Beth.
Thank you very much.